My grandparents never bought a single stock, never hired a financial advisor, never opened a brokerage account. What they did was invest in oil and gas wells in the 1970s, and those wells, decades later, are still producing, still generating income, still sitting in our family with a tax structure around them that most people earning 10 times what my grandparents ever earned have never been offered before. And that's the thing nobody tells you about oil and gas investing. The people who have been doing this for generations are talking about it loudly, and the high income earners who need to hear it most, the ones writing massive checks to the IRS every single April, are always in last to find out it exists. So today, I'm changing that. I'm going to walk you through every tax benefit available to oil and gas investors right now, in plain language, real numbers, actual IRC sections, so that by the time you finish this video, you understand this strategy better than most CPAs who have never worked in the energy space. And I want you to hold one number in your mind for this entire video: $74,000. Just keep that number in mind, $74,000. This is the potential federal tax savings in a single year on a $200,000 oil and gas investment for somebody in a 37% tax bracket under current law. Not over 5 years, not phased in year one. So stay with me. I'm going to show you exactly where that number comes from and what changed on July 4th, 2025 that made this the strongest oil and gas tax environment in nearly a decade. Before we dive into the mechanics, I need to ask you something honest. So if you're earning over $200,000, so that could be W-2, business income, investments, etc., what is your actual strategy for reducing what you owe before December 31st of this year? Not filing accurately, not claiming the deductions you already have, an actual proactive strategy that changes your tax position before the year closes. If the honest answer is I'm waiting for my CPA to tell me what I owe in April, then what I'm about to show you is built specifically for you, because this strategy has to be executed before December 31st. Your April conversation will be 6 months too late. So keep that in mind and let's get into it. Let's decode on why the government incentivizes you to do this. Here's the shortest possible version of the context so we can get into the part that actually matters for your tax bill. Oil and gas investments are direct participation investments into operations that drill for crude oil or natural gas. You're not buying a stock, you're not buying a fund, you are taking an ownership position in an actual drilling operation, and that distinction changes everything from a tax perspective. Now here's the question most people never ask: why does the US tax code give some of the most generous deductions in the entire code to oil and gas investors? The answer is simple. Energy production is not optional for a functioning economy. The government cannot drill enough wells itself, so Congress, going all the way back to the Revenue Act in 1913, the same year the income tax was created, built a deliberate set of incentives into the tax code to encourage private capital into domestic energy production. These are not loopholes, they are not gray areas, they are not aggressive positions that attract IRS scrutiny. They are policies written by Congress, maintained through every major tax reform for over a century, and just made significantly more powerful by the One Big Beautiful Bill Act signed into law on July 4th, 2025. The government is not doing you a favor when you use these deductions. It is doing what it always does, incentivizing private investors to fund the things the country cannot produce enough of on its own. What are the 3 deduction streams that stack on a single investment? There are 3 separate deduction mechanisms available on a qualifying oil and gas working interest. Most investors know about one. Very few understand how all 3 work together. Deduction 1 is a Intangible Drilling Cost, or a IDC. That's IRC Section 263C. When a well is drilled, the majority of the cost, labor, fuel, site preparation, drilling fluids, surveying, are all classified as intangible. They typically represent 65 to 80% of a total drilling cost. Under Section 263C, working interest owners deduct these costs immediately in the year that they are accrued against ordinary income, including your W-2 and business revenue. So it's not capitalized, not depreciated, deducted in year one. So on a $200,000 investment, for example, with a 75% intangible cost, that is $150,000 in year one deductions flowing directly against your highest tax income. And here's the actual structure piece that makes this work for W-2 earners specifically. Under IRC 469C, a working interest in oil and gas is explicitly exempted from the pass passive active loss rules. So most investment losses are passive. They can only offset passive income and sit frozen for high W-2 earners with no passive income to absorb them. So a working interest is different. Your losses are active from day one. They offset your salary, your business income, your capital gains immediately in the year that they are generated. Deduction 2, so 100% bonus depreciation, IRC section 168K. This is where July 4th, 2025 changes the entire conversation. The remaining 20 to 35% of well costs, the physical equipment, casing pump jacks, wellhead infrastructure are all tangible assets. Before the One Big Beautiful Bill Act, these were being depreciated over a 5 to 7 year schedule. Bonus depreciation has been phasing down. It was at 40% in 2025, heading to zero by 2027. So once the bill was passed, it permanently restored 100% depreciation for qualifying property acquired after January 19th, 2025. So gone is the phase down, gone is the expiration. Full first year expensing of qualifying tangible oil and gas assets is now a permanent feature of the tax code. So on that same $200,000 investment with 25% tangible cost, that is an additional 50% in year one deductions, fully expensed immediately on top of the IDC deduction. Now put them together. So $150,000 from tangible drilling costs, $50,000 from tangible asset bonus depreciation. This is a potential $200,000 in total year one deductions on a $200,000 investment. So 100% of that investment is deducted in year one. At a 37% federal marginal rate, $74,000 in real federal tax reduction in year one from a single investment decision made before December 31st. This is a number I gave you at the beginning of the video. Now you know exactly where that comes from. So let's talk about deduction 3, which is a percentage depletion, which is IRC section 613A. This is the one most investors never hear about, and it's the one that makes oil and gas a long-term wealth strategy rather than a year one tax event. So, as the well produces, you deduct 15% of gross production income every single year, and this is for the entire lifespan of the well, past full cost recovery with no expiration. Standard depreciation stops when an asset hits zero. Percentage depletion does not. On $100,000 in annual gross income that the well produces, that is $15,000 in deductions tax-free every single year the well produces. At a 37%, that is $5,500 in real tax reduction annually from an investment you already took the large first-year deductions on. Year one is your intangible drilling costs and bonus depreciation that generate, the large upfront deductions. Years 2 through the life of the well, that bonus depreciation is reducing the effective tax rate on every dollar of production income flowing back to you. So 3 separate provisions, 3 different phases of the investment life cycle, one investment. What is your working interest versus your royalty interest? So a lot of people ask, what is working interest versus royalty interest? Not all oil and gas investments deliver what I just described. The type of interest you hold determines everything. A working interest means you hold a direct ownership stake in the operation. You share proportionally in cost and revenue. That cost-bearing obligation creates the IDC deduction, the tangible depreciation, and triggers the section of the IRC that is the active loss treatment. This is the structure that delivers the full tax profile. Now, a royalty interest means you receive a percentage of production revenue without bearing any drilling or operational cost. You still receive the percentage depletion allowance, that is real value, but you do not access IDC deductions or bonus depreciation because you have no cost obligation. For a high income earner whose primary objective is reducing the tax liability in the current year, a royalty interest is the wrong vehicle. So, one more practical note, working interests are typically reserved for accredited investors, a net worth exceeding $1 million excluding your primary residency, or an annual income at least at $200,000 by yourself or $300,000 with your spouse. If you're watching this channel, you likely qualify. But it matters because the most compelling working interest programs are not publicly available. They require you to know where to look and who to work with. So you may ask, how does the multi-generational dimension work here? Remember, those wells my grandparents invested in, here's why they are still in our family under IRC section 1014. Assets held at a death receive a step-up basis to fair market value at the date of death. The capital gain my grandparents accumulated over decades eliminated at transfer. My family inherited those wells at a current value with no capital gains liability on a lifetime of appreciation. And the percentage depletion allowance continued for the next generation. The same provision that reduced my grandparents' taxable income during their lifetimes now reduces the taxable income of their generations passed down. So, deduction efficiency during ownership, gain elimination at death, ongoing tax-advantaged income for the next generation. That three-phase profile is why oil and gas working interests appear in the portfolios of family offices, sophisticated estate planners, and not just an investment, but as a vehicle designed to pass maximum economic value forward with minimal tax leakage at every transition. The risk? Let's be direct. Not every well produced. Some come up dry, some face operational failures. The production income driving your percentage depletion in years 2 through 20 depends on actual well performance. A geological and operational question, not just a tax question. The first year deductions are real regardless of production outcome. The income generating side carries genuine risk. So that's why operator quality matters. A well-capitalized operator with a track record of on-schedule execution in a proven basin is a fundamentally different risk from an unproven entrant drilling in a unproven formation. Structure matters. The working interest exemption only applies when you hold a working interest in a structure that does not limit your liability. A limited partnership interest typically does not qualify. One structural error and your losses revert to passive, trapped, unusable against your active income. And at that risk, rules under IRC section 465 apply. Your deductions are limited to your actual economic exposure. Programs that attempt to generate deductions beyond actual committed capital are the ones that attract IRS scrutiny. A legitimate working interest generates deductions proportional to real capital at risk. This is not a constraint. That is what makes it legal and defensible. The strategy works, and it's worked for generations, but it works when the investment is real, the structure is correct, and the operator knows what they are doing. So let's recap. Here's where we land. The One Big Beautiful Bill Act permanently restored 100% bonus depreciation on qualifying oil and gas assets. Intangible drilling costs under IRC section 263C remain fully intact. Percentage depletion under section 613A flows for productive life of every qualifying well, and the working interest exemption under section 469C3 means every dollar of those deductions flows against your active income, your W-2, or your business revenue, and your highest tax dollars. The result of a $200,000 investment at a 37% tax rate, a potential of $74,000 in federal tax savings in year 1, from a tangible productive income generating asset that then continues producing tax advantage income through percentage depreciation for decades that follow. But only if the investment is made before December 31st. The IDC deduction requires costs to be accrued within the tax year. Bonus depreciation requires the asset to be placed in service. Your April appointment cannot fix a decision that was not made in time. If you're a high income earner with a significant tax liability this year and you want to understand whether a working interest investment belongs in your strategy for 2026, what the right structure looks like, how to evaluate an operator, what the actual after-tax return profile looks like for your specific income, the link is in my bio. It connects you directly with me one-on-one, and I exclusively work with high-income investors in this space. Not a fund manager, not a syndicator selling a product, but an investor relations manager to help you evaluate whether this makes sense for your situation before you commit a dollar. One conversation, no obligations, and enough time left in the tax year to act if it makes sense. My grandparents made a decision in the 1970s that is still generating value for our family today. The tax code that made that possible is not just survived, it's under the Big Beautiful Bill, and it just got stronger. The one question is whether you're going to be the investor who knew or the one who finds out in April when it is already too late. And as always, this content is for educational purposes only. It is not tax, financial, or investment advice. Always consult a qualified tax professional regarding your specific situation before making any investment decisions.